You got the raise, 10%, a real one, not a cost of living bump dressed up to look bigger. 82,000 became 90,200. Walking out of that meeting, you did the math in your head, figured your paycheck goes up 10% too. It didn't. 4, not 10. 4. You checked twice, thought payroll screwed up, called them, and they said the number was right. Standing in the parking lot afterward, you pulled your old pay stub up next to the new one on your phone, trying to find the missing money yourself, and every single line looked correct, and somehow still didn't add up. Nobody explained where the other 6% went, because nobody in that building actually knows the full answer. Payroll knows the withholding tables. Nobody there knows your IRA. You will know the full picture in the next 12 minutes, because right now, you're the only person who could ever actually put it together. Everyone reaches for the exact same wrong explanation, and it's the one your coworker will tell you at lunch with total, misplaced confidence. Higher bracket, more tax. That's just how it works. Like the government reached into your whole paycheck and took a bigger bite out of every dollar you already had. That's not how brackets work, and believing it is exactly what makes 4% feel like theft instead of arithmetic. A bracket isn't one rate slapped on your whole income. It's a stack of buckets, each one taxed on its own. At 82,000, you were sitting comfortably in the 22% bucket, room to spare. The line between 22 and 24 sits at just under 90,000 for a single filer, which means this raise didn't just bump your income, it landed you almost exactly on top of the line. The raise pushes you to 90,200, which crosses into 24, but only the money above that line gets the higher rate. Every single dollar you were already earning stays taxed exactly like it was before. The new 8,200 gets split. Most of it still lands at 22. Only a sliver crosses into 24. Run the actual numbers. About 6,000 of that raise gets taxed at 22%, $1,320. The remaining 2,200 crosses the line, taxed at 24, $528. Total federal tax on the raise, $1,850. That leaves $6,350 before anything else touches it. Compare that to what the lunch table theory predicted. If the whole raise really got hit at the higher bracket, you'd have lost close to 2,000, not 1,850. The real math is gentler than the myth, which makes the size of the actual gap even stranger. Bracket creep alone doesn't explain it. Something else is eating the rest, and it isn't anywhere near the brackets people argue about at lunch, which is exactly why the explanation feels so unsatisfying once you actually run it. Keep following the 8,200, because federal tax was never the biggest bite. Payroll tax takes 6.2% for Social Security, 1.45% for Medicare. Flat, no brackets, straight off the top. Another $628, gone before you even think about it. This one never phases out, never cares about income, and keeps taking its cut all the way up to a wage cap way above where you are. No ceiling in sight for you. The cap sits north of 160,000, and you won't see it for years. Every dollar of the raise pays the same rate as your very first dollar ever earned. Here's where most people's mental math actually breaks, and it's got nothing to do with tax law. Your employer withholds using a formula that assumes you'll earn your new salary all year. The second your pay changes mid-year, the tables recalculate as if you'd been making $90,200 since January, then cram the catch-up into whatever checks are left. Raise lands in September. That catch-up gets squeezed into 4 months instead of 12. The system's trying to collect a full year of extra tax in a third of the time. So your withholding on the raise runs noticeably higher than its real annual rate for those last few checks, sometimes by several points. Enough that a check in October can look meaningfully smaller than the one in November, even though both reflect the exact same annual salary, and nobody adjusts for it, because the formula's doing exactly what it was built to do. You're not being taxed more, you're being taxed correctly, just on a compressed schedule that hurts more than the real number says it should. Then benefits. This is where most of the missing money actually lives, and it's the part that costs you without ever once feeling like a deduction, because nothing about it looks like tax. Your 401k is set as a percentage, 6%, so it scales automatically with the raise, quietly pulling another $492 a year, You never agreed to increase. Health insurance stays completely flat, $210 a month either way, but it's coming out of a smaller share of a bigger check now. So it feels like nothing changed even though it took the exact same bite it always has. Stack the federal tax, the payroll tax, the front-loaded withholding, the automatic retirement bump, and you've got most of the gap. Almost all of it. Not quite. There's still a piece missing, and it's the one piece none of these systems were ever built to notice. Here's the part that turns this from an annoying paycheck mystery into something worth actually caring about. Somewhere in that pile of vanished dollars, one specific number disappeared, and it has nothing to do with brackets, payroll tax, or your 401k. Maybe you don't have a traditional IRA. Fine, hold that thought, because the specific account doesn't matter, the mechanism does, and you'll see in a minute how many other doors work exactly the same way. For this walkthrough, before the raise you'd been contributing to a traditional IRA and deducting it, $2,500 a year on top of the 401k. That deduction was never guaranteed, and here's the condition that made it fragile from day one. It only applies to people covered by a workplace retirement plan, which you are, because of the 401k sitting right there on your pay stub. Covered employees get the deduction phased out once income crosses a line, and for a single filer, that line sits around $73,000 to $83,000. At 82, you were inside the window, deduction shrinking but real. Maybe $1,800 of the original $2,500 still allowed. At $90,200, you're fully above it. Gone. Not reduced. Gone. The math inside that window is a straight line phase out, a little less deduction for every dollar you earn, right up until the top of the range erases it completely. That $2,500 deduction was worth about $550 in real tax savings every April, money that quietly funded part of your refund the last 2 years running. Nobody flagged it when the raise went through, because nobody in payroll checks your IRA against your new salary. Payroll knows your salary. Your brokerage knows your contribution. The IRS is the only one who ever puts those two numbers in the same room, and it does that once a year, in April, months after the decision that caused it. The system that pays you and the system tracking your retirement deductions don't talk, and this only shows up 7 months later, in a different building, when your accountant asks why your refund shrank the same year you made more money. If you don't use an accountant, it's worse. Most tax software will still let you enter the IRA contribution and claim the deduction, then flag it as disallowed only after you've already filed, or not flag it at all if you don't dig into the worksheet. Add all of it up, piece by piece. $1,850 in federal tax, $628 in payroll tax, roughly $492 more into the 401k, automatically, $550, gone for good. Layer the withholding timing on top and the math finally closes, dollar for dollar, against the 6 points that seemed to vanish. What looked like one unexplained gap was never one mystery. It was 5 separate systems, each working correctly on its own, each blind to the other 4, all triggered by the same event, landing in the same check at the same time. Your version ran through an IRA. The next person's runs through a different account entirely. The mechanism is identical either way. Here's the part that should actually bother you, and it's got nothing to do with the money already gone. The raise didn't just cost you 6 points this year. It moved you permanently into a different zone of the tax code, one where benefits that used to be automatic now need you to actively manage them or lose them without noticing. The IRA deduction is one door. There's a health subsidy that works the same way for people on marketplace insurance, a cliff instead of a taper, gone the instant you cross it. But neither of those is the one that should actually keep you up tonight. If you're on an income-driven student loan repayment plan, your monthly payment isn't fixed. It's recalculated once a year, usually at recertification, off whatever your income happens to be at that exact moment. Cross into a higher bracket right before that date, and the new payment gets set off the higher number for the entire year that follows. $80 a month. $100. More than $1,500 over 12 months, on a raise that, after everything else already took its cut, might not have even cleared that amount. Notice what this one does differently from the IRA. The IRA deduction just quietly stopped existing. Nobody chased you for it. This one comes looking. It doesn't sit there passively waiting to be discovered in April. It shows up in your bank account every single month for a year, an actual bill, actively higher, because a form you filled out months ago just quietly recalculated against you. Nobody at your loan servicer calls to warn you it's coming. Nobody at your company connects the raise they gave you to the bill you're about to receive from an entirely different institution. The math runs in the background, on its own schedule, and the new number just appears, already due. You'd assume more income only ever unlocks better treatment, never worse. This is the door where that assumption quietly breaks. And it's the one door in this entire video that doesn't wait for you to notice. It bills you whether you notice or not. The 4% you actually kept was never a mistake. It was 5 separate systems, each working fine on its own, none of them knowing about the other 4, all set off by one number changing on one day. 3 things, and every one of them, is a thing none of those 5 systems will ever do for you. Pull your last stub before the raise next to your newest one and trace every line that moved, not just the take-home total. Withholding, the 401k dollar amount, every deduction, the real figures, not the percentages. Nobody is going to hand you this comparison. You have to build it yourself, because the summary number was never going to tell you. If you're on an income-driven repayment plan, check your recertification date now, today, not the week it's due. Run your new income against the published numbers yourself, because your servicer will recalculate whether you check or not. And the letter that tells you the new payment is not a warning, it's a receipt. And decide on purpose whether your 401k contribution should keep scaling automatically with every future raise, because right now, it's making that call for you, quietly, every time your salary moves, without asking, exactly like everything else in this video already has. You got exactly the raise you were promised, in full, precisely as written on the letter. The paycheck that actually showed up was decided by 4 other systems that were never in that meeting and never once bothered to introduce themselves.